Welcome to the EY NextWave Private Equity Podcast, where we explore what's happening now, next, and beyond in the world of PE. Digital, sector, talent, value creation, ESG. These topics are top of mind for executives across the global private equity ecosystem. Join us for the insights you need to reframe the future of private equity. Now, here's your host, Winna Brown from EY.
In today's podcast, we will explore everyone's favorite topic, and certainly a key underlying focus for private equity. That is bringing cash flow. I'm really excited today to be joined by my fellow partners Sven Braun and Nick Boaro from our strategy and operations practice. Sven and Nick lead our private equity working capital practice. Gentlemen, welcome to the NextWave Podcast.
Thank you so much for having us.
Yeah, thanks for having us.
An absolute pleasure. Now, guys, I'm sure no one will disagree that fundamental good business practices would suggest that keeping a healthy cash balance is important. I think it's especially critical for private equity companies who are typically highly leveraged. The capability to release cash in a timely manner to provide liquidity to either weather economic downturns or to fund strategic objectives is something that both of you, I know, have been working really closely with our private equity clients to build. Maybe we should really start our discussion today with the basics. Why would you say that having a cash culture is an important cornerstone of a private equity investee playbook?
That's a great question, and this is Nick here. Where most companies think about cash flow is actually getting back to the fundamentals of running a business. In the current environment, cash and working capital is the cheapest source of liquidity a business can generate. So it's not only a steward of good business fundamentals, but it's also helping fund the business through a downturn or through growth. It typically results in about 5% of cash flow being tied up in the business.
Let's address the elephant in the room here. I mean, I think everyone's worried in today's economy, and certainly with the COVID-19 global pandemic, that you can't just walk up to your bank and refinance. So how do you find that the global pandemic is actually impacting your clients and yourself today?
I've got to say we're extremely busy. So what we're seeing at the moment is kind of a dedicated focus around all things cash flow. So in the last 5 years, we've probably seen a lot more of preparation for a potential downturn and shoring up balance sheets to sustain a business through prolonged downturns. Now we're seeing the same playbooks being more aggressively applied, digging into cash flow forecasting, understand what the true impact is. It's about releasing cash tied up on the balance sheet through accounts receivable, through accounts payable, supply chain impacts that we're seeing. It's really disruptive right now, and we're all looking for ways to extend and prolong the business sustainability. So right now is no better time than ever to focus on cash flow.
Yeah, hi, and this is Sven. Just want to chime here in on this. So one of the elements that we see day to day right now is just cash becomes even more important for our PE portfolio clients. I can give you one example from literally just 30 minutes ago. We had a conversation with clients around how does it impact me? What are the changes to the tax policies right now? And we're seeing come through something that we have already assessed in the past months in terms of the importance of cash flow for our PE clients. We actually ran a survey and it came out that the second most important element in value creation for our PE clients is working capital optimization right next to the operational cost improvement initiatives. And we're seeing specifically the working capital and cash flow lens supported in this more challenging times because right now you cannot count as usual on revenue expansion as much. So the PE clients are really stuck with cost optimizations and liquidity management and cash flow management to keep the business running. And when you look at this from a sector lens, specifically in tech and in life sciences, there is a big focus on liquidity management and working capital optimization. And specifically on life sciences, it's become even stronger because you have specific government legislations that just limit right now how much you can do when it comes to cash flow management and also specific schemes that are in place, even in a stable environment that would impact cash flow of the businesses.
So, Nick, do you want to give us a perspective maybe on technology?
Absolutely. So on the technology front, we're seeing a number of things. It becomes a lot more about not only the individual company's liquidity and cash flow, but what's happening in their customer base and what's happening in the supply base. If you're a technology company serving retail, you're having a lot more interesting conversations around payment profile and what you're going to expect in cash inflow from those customers. Similarly, on the supply side, there might be certain suppliers that are absolutely critical to the business and may need additional liquidity if you are in a position to support it. So we're seeing a lot of focus not only on the company themselves, but on the end-to-end value chain of where, coming out of a rebound, how the company is going to be most successful and continue to grow. So in the software space, in the hardware space, all an area of focus that this kind of pandemic is creating.
Is it safe to say then that healthy, strong cash flow in the best of times is something that a company aims for? But if you're in uncertain times, as we are today, it's most especially important to help a company be resilient and to make it through the other side. And in fact, to grow on the other side to ensure that there's a healthy cash flow position. Is that right?
That is correct. So when I look at companies going into this period of time with healthy balance sheets, with great cash flow, it's truly a sign that they've prepared for this time. That said, it is not too late. So there are a lot of companies that are taking aggressive measures to accelerate cash flow and manage their customer and supplier relationships in a bit more structured manner, allowing them to extend the profile. So effectively, strong balance sheets, strong cash flow, sets you up for success. And actually, we're seeing a few of those companies start to look at opportunities in the market to acquire companies that might not be in as great a position. So it does position these companies well for success.
So if we were to kind of unpack that, what are some of the primary and secondary benefits that we're seeing companies have as a result of optimizing their working capital?
This is Sven. I think the primary benefit is pretty obvious. We're looking into increased liquidity and predictability of cash flow. And this really helps you plan how you disperse cash, plan how you run the company, and basically execute the business well. The other piece is auxiliary, so which means what comes with it. So you cannot really improve disbursements of cash, or you cannot really improve the operations of cash flow without looking into the organization and the processes themselves. So we typically see that companies are better run. The organization is more structured. You have clear levels of ownership. And ultimately, PE clients improve how assets are being valued by being more efficient and process effective when it comes towards anything that impacts cash. There's always P&L benefits that come out of working capital focus, just simply because we typically see clients establish better metrics and more visibility in all the areas of cash and surrounding them. And that just helps drive the cost lens in parallel to the cash lens, because it's really about not giving up any benefits, but really getting the best of both worlds.
And Nick, I mean, if we kind of think about this a little bit more, you guys work a lot with PE funds and their portfolio companies. Where are we actually seeing the cash being unlocked? Not every company out there is a good candidate for working capital optimization. You can unlock more value for some companies than other companies. So if you can give us a flavor, maybe, of what are those typical best candidates?
Absolutely. One of the things we're seeing, there's a number of items that are consistent across the funds that we're working with, and there's a few differences. So the consistency is almost every fund in this environment is asking their portfolio companies to provide liquidity forecasts. So cash flow forecasts weekly. Some of them are doing weekly report outs to the fund at every portfolio company level and understanding where the risks are and where the opportunities may be. That seems to be fairly consistent across the portfolio, across all the funds that we're working with at the moment. Similar to that, I would say there's also a focus on act now. So let's draw down those revolvers. Let's figure out what levers we can pull to accelerate cash flow for as many companies as possible. And we can unwind that should this not turn out as bad or as prolonged as we think. But I see a lot of private equity owned portfolio companies taking all steps that are available to them right now and unwinding that as things get better. So where I'm going with that is that's consistent. I think what's different is that there are some funds that are deploying teams actively in those high risk companies. Usually it's one operating person with maybe, it might not be a restructuring team, but it's certainly a turnaround effort around making sure they survive beyond the liquidity range that's been presented to them. So it's extremely interesting times right now. And the sectors, like Sven mentioned earlier, healthcare is in some pockets doing really well, and others, like elective procedures or elective medical devices, not so great. Retail obviously being challenged and short-term liquidity actions needing to be taken, whereas software, as we mentioned before, in a little bit better shape, but it depends on what sector they're sitting in and serving. So almost every company is open to cash flow improvement and liquidity improvement. And what we're seeing is there's no kind of sector not impacted today. I think it's effectively just the nuances of that individual business and what can be delivered.
That makes sense. And so what we're seeing is depending on where the company is in its life cycle and its access to cash and how at risk it is, it's using this unlocked cash in different ways. Is that what I'm hearing? To take advantage of the situation and perhaps use it for acquisitions or strategic opportunities, or to self fund, or in fact to just meet debt obligations. Is that correct?
Yeah, I think what we've seen lately that there is a shift in the way the portfolio is being run by PE firms. So in the past, we've seen more short turn around acquisition strategies. Nowadays, it's really more buy and build. So a lot of the cash is being reinvested into the portfolio company because that really generates real cash and cash returns. So we've seen examples where the business, for example, that's a pharma business, has invested cash freed up to self-fund clinical trials rather than to go back to a revolver. So you can expect it as an additional investment typically into operations nowadays. It doesn't mean that if it's a company that's also publicly held, that's publicly available, that there's a share buyback happening or other elements that cash is being used for. But yeah, typically we're seeing the cash being used right now really as an investment into the business and into the sustainability and the future of that business.
So guys, you know I'm your biggest fan. I think it's really just a no-brainer for all companies to focus on releasing cash and improving processes, and doing this from within in the first instance through working capital optimization. My question to you is, are you now seeing all PE funds jumping in and embracing this approach? Or are you still seeing companies out there who are not thinking inwardly about cash flow and liquidity?
Fantastic question. It's actually two sides of the coin. We're seeing some companies accelerate and really think through, how do I address the current environment? How can I release cash, the cheapest source of liquidity, and pull it out of my business? And the volume of work that we've got coming our way has significantly increased. That said, there's still a few companies out there where management believes that this might be shorter term, or there's some of these actions might not be needed at this time. I think what we're going to see, similar to 07, 08, and is a little bit of a creating opportunities in terms of companies and management teams that are really strong and kind of thrive in a rebound, and those that are going to be a little bit lacking in their opportunities to reinvest, not having pulled down all the options available to them. So it's an interesting time where obviously a lot of companies are really focused on this, and there are still some that surprisingly are not really thinking about cash flow as much as they should be.
And what's the possible downside to those funds who are actively trying to unlock working capital in their investees?
The downside, as I see it, is a lack of options. Having cash provides options to reinvest in a new product line, to acquire a new company, to ensure some of your suppliers and or customers remain liquid. That optionality does not come for nothing. So you have to release the cash within your own business to give your business options to thrive in the future. The lack of focus is almost kind of giving you one option of survive. Survive without pulling all those levers and all those other opportunities that could come about by having additional liquidity. Others will be taking advantage of.
Well, that makes sense. I was just thinking as we were talking, is there a different approach when you're working with PE funds versus directly with corporates?
Yeah, I think the key sentence here is speed to value. What we see when you think about large corporate businesses that are publicly traded, think about Fortune 50, Fortune 100 companies, they're moving a lot slower when it comes towards just the speed of execution of the programs and the need to realize benefits. There's a few elements to that which make complete sense when you think about it. So for example, if you're publicly traded, there are things that you can actually, let's say, quote unquote, break from a financial expectations perspective. So if you immediately realize a boatload of cash, for lack of a better word here, the market might expect you to continue doing that and might have adverse effects towards that in the next quarter. So for the corporate clients, it's really important to be clear on the program, be clear and measured in the impact, and really execute in a very efficient manner and hit exactly what is being communicated to the street. For private equity, it's a bit different. I mean, we're looking into a cycle of 5 to 7 years of most of the investments that are being made. And so you want to realize value as fast as possible. And coming back to the points that Nick made, it's really about realizing the value as soon as possible because, again, we have time value of money here. So if you can free up the cash in a shorter time frame, you can invest it earlier into your business in any way you want to and basically capture costs for the future. So yeah, typically think about large corporates, publicly traded companies. They have very often more complex hierarchical structures that are a bit more challenging. Private equity is just faster to the trigger when it comes towards how they want to execute their portfolio companies. It's typically helpful because you can get the full business really aligned towards executing quickly and successfully as well.
Hi, Sven, and I'll add to that. I think in the corporate world, we see a lot of focus on the balance sheet, on the metrics, and cash flow is an output of the financial statements, not necessarily a driver. In private equity, there's an understanding of cash. There's a lot of debt that's thrown on some of these businesses, and there's really a need to focus on cash flow as opposed to what the impact is on the balance sheet. The balance sheet's kind of the output of the cash-driven exercises. So that's really one of the bigger differences, is less about balance sheet management that you might see more on the corporate side and more about cash flow management that certainly exists in the PE world. I think that's one of the other big drivers of difference between PE and corporates.
Given the differences between the PE model and the corporate model, have you been able to work with operating partners or deal teams and help them think through how they can focus on those key portfolio companies and which ones there's more significant value to unlock? Have you developed a system to partner with them?
We have. Put simply, a lot of private equity funds, when they build operating teams, they're building on some of the more traditional value creation levers. So cost takeout, supply chain, sales force effectiveness. They don't buy or build internally cash flow improvement teams. There are some rare examples of where that exists, and some of them we obviously have worked directly with them to make that happen. But effectively, we supplement and complement the team, the broader operating team, and have the same cash flow lens that we would apply in any other organization, but we help them apply it across the portfolio. I will say that there are some funds that have a more pragmatic portfolio company to portfolio company approach, going after an overall value of what they're trying to achieve in cash flow across the portfolio, and others are more ad hoc or as needs arise. So there are different models that we deploy across different funds, but there certainly is varying levels of focus that enables us to be successful in any situation that we're putting into. It is extremely powerful when we've got the pragmatic, structured approach going across the portfolio, in many cases delivering over $1 billion of cash flow across each fund. In other examples, it's typically, like I mentioned before, about 5% of sales we're able to release and deliver within, say, 3 to 6 months. So we have approaches that allow us to get right into the heart of delivering value.
And how critical is technology to your approach? Do you leverage significant tools to help complexes effectively diagnose and unlock and essentially deploy working capital?
Yeah, I think technology has become crucial to what it is we do and how we execute our business. When you think about where we came from, I think just maybe 4 or 5 years ago, if a client had multiple different ERP systems with complex layers, it sometimes happened to be a multi-week or month-long endeavor just to clean the data and fully understand how everything ties together and then basically build models to help understand and make sense of the values. Because essentially how we use the data and how we've always used the data is to get an understanding about the business, what good looks like. Because that gives you a more objective perspective of the reality, which is then being enriched with additional insights. So what we've seen lately, just in terms of the advance of big data analytics and the ability to visualize and really rapidly ingest huge amounts of data, we've seen two things. So the ability to do assessments has improved exponentially. So when you think about multiple ERP systems and complex businesses, which might have taken, let's say, again, a few months in the past, now we do this kind of work within a number of weeks, even for the most complex companies. And then also when it comes towards the execution of really towards those businesses, because in the end, when you want to execute, you want to measure to see if you really capture benefits. In the past, when you wanted to deploy a really nice and sweet solution to really measure, for example, your metrics or your business impact, it might have taken months to really fully integrate it into the IT systems of your clients. Nowadays, you can set this up in the cloud. You can do it basically in 8 to 12 weeks, whereas in the past, this might have taken 3 to 6 months.
And have we got any particular tools or technology that EY uses to deploy our working capital strategy?
Yeah, and this is Nick, and I can address that. We do have roughly 200 people in the US alone dedicated to working capital, and we actually have an even larger sizable team globally. So we're operating all the markets that are relevant for most of our clients, and we deploy the same approach across the world uniformly. So we know biggest doesn't mean best, but what it does allow us to do is invest in our tools and invest in our capabilities. So we have proprietary tools that we've built over the years that allow us to go at the value quicker, to go at the value and deliver more, and in many cases leave those tools behind so that the company is able to maintain and sustain the value in the long run. So a lot of these tools, as Sven was mentioning, are kind of bottom-up builds of transaction-level information that allows the company to really understand what's going on in the business and to make better fact-based decisions to improve the results.
So, out of curiosity, without these tools at your disposal, let's go back 10 years, 15 years. How long would it have taken to do one of these assessments to help companies think through how they can get more liquid or be more liquid?
In the past, you were thinking about a duration of about 3 months, typically, to do an assessment. I think Nick has mentioned that as now we're really tying this down towards 2 weeks to do a really rapid assessment. I think what's even more interesting based on the new tools, what's shortened down more is even the most complex companies, and I talk now about Fortune 50 businesses, which in the past have taken a year in some cases, which sounds extreme, but we've seen that. Even those we can now tie down basically in a 3 to 4 weeks horizon. So think about the more complex the business is, the bigger the gains are now due to the new technologies and the team that we have supporting it.
Sven, let me add to that. I think it's not only the speed of which we can accelerate those assessments, but it is also the accuracy and the quality. So I think we're able to get to, within a week or two, an opportunity by lever of improvement and the timeline of what's broken in the process that needs to be fixed, the timeline to improve that process. It becomes a much narrower range of opportunity as quick as possible. So it's really impressive what we're seeing now get done in about a week or two worth of work in the private equity space particularly.
That's pretty incredible. And so from my perspective, I think that it feels like it's an absolute no-brainer for all companies to really think about ways that they can leverage the technology that we have at our fingertips to help them free cash flow and make them more liquid, not only for today's time that we live in, but really at any point in a company's life cycle. Having more free cash has got to be a fundamentally good business practice. As we try to summarize, and there's a lot of areas that we spoke about today, if you had to narrow it down to a few key takeaways for our audience, what do you think that they should be bearing in mind as they're looking to create a more liquid portfolio company for themselves?
Yeah, this is Nick. I can go first. I think there's three takeaways for me. One is why companies want to care about this, and that is this is the cheapest source of liquidity, and the companies that have the liquidity will have the options to reinvest for growth. Optionality is always a good thing, and I think that's the why. How much, I think, is really important as well. That 5% of sales, we very rarely miss that number. And there are some circumstances where it's only got certain portions of the business, but 5% of sales is a very large opportunity in terms of cash flow that's able to be released. And then finally, speed. I think speed to identify the issue and then speed to deliver the value tends to be within 3 to 6 months. You have all of that money in your pocket. In some cases, much quicker. So those are the three areas I look as large takeaways.
I think the only thing that I would add on is count the cash while it's coming in. Not only is it fun to see the benefits coming in, and it's in this case really that you can say cash is king, but it's also important to capture the story and capture the success and basically leverage that story with your other portfolio companies to get them excited about the same journey. As Nick said, it can be replicated and it can make your portfolio clients a lot more successful.
Fantastic. So, Sven, Nick, thank you so much for joining us today. We all really appreciate your insights. It feels like it's just a no-brainer, and I know I've said that before, but focusing on working capital and creating efficiencies in processes to release cash and create a cash culture mindset feels like it's something that every private equity complex should be thinking about, and every portfolio company and indeed corporate out there should be focused on. So thank you again for your insights. Most appreciated.
Thank you for having me.
Thank you.
Thanks for tuning in to the EY NextWave Private Equity Podcast. For more thought-leading perspectives and to get in touch with Winna Brown, visit ey.com/private equity. You can also follow us on Twitter at EY Private Equity. We'll see you on the next episode.